If you're a nervous Nelly and you need a tight stop, that's fine, you know, but you have to have the stability up here to know that your maybe going to get clipped 6 times off the run. Now, the question is, can you press the button on the 7th time and at the same position size that you were going to take after you've just been hit 6 times? A lot of people can't, you know, but then you've got the other side of the coin as well. What if your stop is way too big? You know, then it only takes one trade to knock you out of the equation. For me, I'm somewhere in the middle.
Welcome everyone to episode with Gary Langley, the Scruffy Trader. Looking forward to talk about trading, his experience as a funded trader for the past 2 years. Gary, welcome back on the podcast. Good to have you here again. Good to chat again with you and see what you're up to and what's new with you.
Well, the only thing that's new with me is I'm a little bit balder and a little bit fatter since the last time we spoke. But trading-wise, life's pretty good.
Awesome.
Because I treat trading the same, to me, it's just a job. So it's the same day in, day out. I don't look for newfangled things. I don't swing for the fences. It's just go through the grind.
So last time we spoke, you were funded with the Fivers. You had a few accounts with them, I believe. How has that evolved since last time we spoke? Have you been keeping the same capital, or have you been trying to get more capital, or how did you sort of go about it?
More capital is always on the horizon because every time you hit a milestone, it increases. Now, the last time we spoke, they brought out a new program called the Freestyle. I don't think it's available anymore, but legacy people like myself are allowed to keep it. I sent you the statements of that. We passed that. And through the last year, just to give an idea of what prop can achieve for you, you'll see I'm sitting in a different background. It's because prop has paid for another house of mine. And that's what we're sitting in right now. So it's all about bonus to a wage. You know, I still trade my wage account, which pays the bills. But if you've got prop sitting next to it and you're reasonably good at it, because that's the caveat. If you're not very good at trading, don't take on prop because you're on a losing battle. But if you are good at trading, it can accelerate your wealth. And that's where we're sitting here. You know, call it compounding if you like, passive compounding.
Definitely a good one there for sure. But tell me, what do you think makes the difference between the people who try profit challenges but fail, or they keep trying it and like paying and then they always fail them, versus guys like you who are able to stay a long time with like a same platform, same account, and like keep at it? What makes the difference there?
I think it's the difference of trading full stop. A lot of people see the way the industry is sold. Now, the industry is always sold on the big money, always. And the prop industry can be guilty of this because they say, right, we're going to give you a £100,000 account. We're going to give you a £200,000 account. Well, they're not really. What they're actually doing is giving you buying power. The account itself is actually just the drawdown. So the drawdown could be very small. But what happens is if you're not well up on trading, if you like, and you just sort of see the flashy lights, you think it's a quick way to massive money. And what happens is they put too big a position size on, the drawdown can't take it, the account explodes, and they think, oh, no. But then they're caught in the hook, the gambling mentality. So they keep going back and back and back again. But trading is like that anyway. I think what trading needs is a little bit more respect of what you're doing. I'm giving a talk at an expo this year in London. I'm one of the guest speakers of Traders Day Live. And my subject is growing a small account. And the main hinge pin of that is respect of the account. Because if you've got £1,000 and you don't respect it, you'll blow it because you make 20 quid off it. You think, well, it's only 20 quid. Go McDonald's and buy a meal for 20 quid. It's nothing. But in reality, to £1,000, that £20 growth in a day is huge because there's not a bank on the planet would give you that. Not one. So it comes down to respect. Now, if you respect the process and you respect the size of the account, you'll survive. But if you go in with a gambling mentality, you've lost before you start. And if you're going in looking for the big money when you don't actually know what you're doing because you think it's easy because you've seen something on YouTube or something, again, you fail before you start. This is a job, plain and simple. And nobody learns a job in a day. Certainly not one that pays you £100,000 a year. And that's kind of my take on it anyway.
Yeah, you do make a good point that a lot of traders are focused on the results, like the P&L, the profit, the income at the end of the month, but not the process so much. Have you always been that way, focused on the process from the start, or is it something you kind of had to build or bring into trading over time?
No, I was pretty much from the start because I came into this industry by accident. I don't know if you remember the story of how I came to industry when we spoke last year. Trading was part of my job, but it was a different type of trading. It was forward purchasing where we lock in an exchange rates or we're buying a physical asset. So I had a process already hammered into me from day one. When I started day trading and eventually it became my job, those traits were already there. So it was just a case of it takes money to make money, but you've got to get the money in the first place. But the process is number one. Kind of to give an analogy, if I go back to when I was a very young man, probably into the Stone Age for youngsters like you, I served an apprenticeship as a plumber. And I did that when I was 17 years old, and I'm 53 now. Right? Money was never a factor when you're an apprentice. You have to learn the craft. You have to learn the job. And if I had a go at my boss and said, well, I'm doing this and I'm not getting paid enough, well, he'd just hit me with a hammer, because that's the way it was sort of back in the 80s. There was no health and safety and there's no political correctness. Clunk, stop complaining, get on with it. But get on with what? The job. So as long as I did the job, I was left alone. And then as I got better at the job, I got a pay rise. And then when I got more qualified, I got a better pay rise. And we should be treating that industry the same way. When you're just starting, you're not a professional. You're an apprentice. And all apprentices have to learn.
What would you spend time on if you were to be a new trader again and you want to learn trading correctly? What would you kind of try to do? What would you avoid more? Are there some things you would spend more time on than others?
Well, the first thing I would do is avoid the money aspect altogether, as we're touching on. Forget about the money. The money will look after itself. But it's setting up a routine rather than focus on an area. If you have a routine, then that becomes repetitive. And once you've got repetitive, you'll get muscle memory. And each time you do it, it gets better. So wake up in the morning, set your screens up. So I pay heavy attention to levels. So learn how to do your levels fully. Know which ones are the key markers. A level on a 5-minute chart means nothing. But when you're starting, all the action's on the 5 minutes. So you naturally think that's the levels. So what have you taught yourself? You taught yourself a bad habit. But if you come out of the chart and you look at a monthly, weekly, daily and concentrate on those levels, those will ripple through time to your 5 minute. So your levels is key. Then understand why a market will turn at such a level. Is it at an extreme point? Well, if it's at an extreme point, you need to understand what indicators can show you those extremes. A Bollinger Band, an RSI, a stochastic. They can show you extreme market points. So there's something to concentrate on. And then finally, common sense. We've just had CPI this afternoon. It would be foolish to try and second guess it. And then when the market's moving at its fast motion, to try and jump in on that market. So you've got to learn yourself patience. And that patience comes from, well, I know there's a news event coming, so I'll have to sit out of the market. And that's another thing to concentrate on. And that's why I say common sense, because you should be part of your routine, first part of the day, look for the red folder events and know when to trade. Because knowing how to stay out of the market, I think, is as important as how to get into the market.
I gotta say, it's very, very rare to see traders who are fairly emotionally stable in the sense that they don't get hyped up about wins or profits. They just stay very stable. If they have a loss, they stay very stable, don't really care too much about it. They just move forward, keep going with the process. I think the people who do this eventually are the ones who are successful. The ones who don't do this, the ones who kind of keep losing money or keep kind of failing over time.
Well, don't get me wrong. I think a lot of successful traders, certainly ones that I know, we kind of like ducks and swans. On the surface, we look like we're gliding, but underneath the water, we're giving it this. We're giving it all hell. Trading is probably the biggest emotional roller coaster you ever go through. And simply because you're dealing with money all the time. And money, as my dear old gran would say, money will see you out. And what that means is it shows the real person inside. So if you're very money orientated and greedy, as soon as money's involved in any conversation, that'll exaggerate. Now, trading can pull that out of you like there's no tomorrow. And when you're on a high and you're riding the right trend and you're seeing the big trade, your emotions are sort of, I'm invincible. But suddenly, what if it's snatched away? You're humbled back down to childhood. So the emotional roller coaster is like this. And if you are that way inclined, it can play havoc with you. And the only way you'll control that is by sizing down. So don't let the highs mean that you're invincible, that you're going to size up. In fact, I've seen more traders blow accounts off the back of good winning runs than off losing runs because they genuinely think they're invincible. So they'll take mediocre trades because obviously they're not wrong. They've been winning everything, so they're not wrong. And because they're not wrong, they put the position size on too big. Bang. They get caught on, like this afternoon, for argument's sake. I can second guess the news. I know what's going on. Click. CPI comes in. I don't think so, boy. We're going to show you exactly what's going on. 100 points the opposite direction, and bang, your big account has just been dented badly. So I guess, for me, if you treat it as a job, it'll pay you as a job. And I'll go back to what I said at the start of this. You have to treat your accounts, your position size, and yourself with respect. If you respect it, you can understand it. And if you understand it, you can apply common sense. And that'll get you through the day. It's just a job, nothing more.
How do you feel over time as you get to trade bigger and bigger size? Is it because, of course, you grow your account, you get more funding, so you have to kind of adapt? Do you feel any kind of like a going out of your comfort zone a little bit more, like you feel like stretched a little bit more, like a little bit more tight as you get to manage more money? Or is it pretty easy for you to kind of jump and increase your account balance and not really care about it too much?
It's kind of a double-edged sword. Now, I came from an industry where I was used to big numbers anyway. But what happens is the bigger the account, the more your mindset comes into play. Even though you can see your setup and you think it's perfect and you know it's going to run 30 pips or whatever, once the numbers rack up, you start getting a very itchy trigger finger. Because if it's going the opposite way, they rack up really bad. So the emotional roller coaster really does swing. Now, the way I do it personally is I switch the P&L off. I don't look at the P&L. I know I'm going in at £10 a point. I know I'm going in at £20 a point or whatever it is. But if that moves 10 pips, suddenly that number looks pretty big. And if that goes 50 pips against me, that number's pretty massive. It scares you. So switch it off. And then you can control the process. But you're looking at little accounts. I think a little account is harder to trade than a big account because you haven't got much room to maneuver with a little account. The mindset behind a little account is a hell of a lot different to a big account. And it goes back to respect. You don't treat the little account with respect. So you blow it over and over and over and over. But when you get up into the big accounts, yes, they're easier to trade because you can buy yourself out of trouble. You can open up any asset. And you don't really have to worry about margin calls if you've sized appropriately and you put your stops in the right place, sort of thing. Little account, you've always got the margin call against you and all this different sort of thing. But up here it changes. And even today, I struggle with that. And that's why I switched the P&L off. You know, I get in, I get out, I get paid. And I have certain rules in place, like score, score, stop. It's a little mantra that I preach all the time. And all it means is if I've had 2 good wins, that's me done for the day. Because if I try and go back to the market for the third one, I'll guarantee that's when the market rotates and cracks me one. So I just step away, you know, and I have these little mantras all the time. And I also have another one. I only allow one loss. If I lose on the day, I'm done for the day. You know, that's it. I'm not going back to market. I'm out of whack with it. I'm not in tune. If I lose again, because of the numbers that I'm dealing with, these numbers become pretty big. And I don't want to be, well, I just don't want to sort of talk to my wife when I'm in a bad mood because I've had a bad day in the office. I'd rather just cut my losses and come back to it tomorrow. But I've also got a risk profile for the week. I allow myself a certain amount of money for the week, which says 10% of the account. I'll divide that by 5, which gives me 2% a day. And then I'll divide that into the trades that I'm going to take. But if I was stupid enough to use that 10% in 2 days, I'm done. So I have little, call them breaks, if you like, sort of car breaks. Once I've hit it, I pause out, step away, clear my mind down, come back.
This is interesting because a lot of people could feel like they miss out on the market if they do that, because they feel like maybe as new traders that they kind of have to be there to take the trades when the trade kind of present themselves. That by taking only one loss, we would kind of miss out on big moves in the market. So how do you feel about people who would kind of argue that way, where you kind of miss out on
Well,
some
I would
moves in the
call that
market?
revenge trading. If I've had a loss and I've timed myself out of the market, I can't go back to market because I've literally used up my allotted allowance. If I go back, what have I done? I've broken my rules. You know, these are rules in place to, one, make certain I'm paid every week. I control the account so it's not damaged to the point of destruction, but it also keeps me level-headed. Now, if I break those rules and just say, oh, well, I should have really taken that. Well, what's the point of having the rules in the first place? That takes me into the gambling mentality. And a gambler will always be looking for the high. They never, ever plan the days out. It is, I guess one of the worst things you can have is you've had your losing day, but then you won it back the next day. But you didn't actually know why you won it back. You just happened to have hit a good run. So now you're chasing the dragon over and over. And you can only pull its tail so many times, and it's going to turn around and burn you. But no, if I've got rules, they're in place. And those rules have to be stuck to. And if I break them, I'm revenge trading, and revenge trading will lead to the destruction of your account.
How often do you go back and look at your P&L? Is it like a once a month kind of thing? Is it more often, or?
Oh, no. I look at it at the end of the day. While I'm in a trade, I have a marker in my head, roughly how much I want to earn per day. And that's built up by, I know what my yearly salary is. So I break that down by 48 weeks because I like to have a holiday. I'm not going to trade when I'm on holiday. So I have 4 weeks off a year, you know, Christmas, Easter, a couple in the summer, that sort of thing. That's then broken down to roughly a day target. So I know roughly how much I need to earn per day. Now, it's not a set in stone figure. It's just a sort of guideline. And I'll do a trade. I'm happy with the trade. I get out whatever the trade is willing to give me. And it's based on a formula that I have for my position size, because I don't do the mathematical gymnastics that some do, why my stop's here and this is there, so therefore my lot can be this. I have a fixed lot size, and it's based on the size of my account. Now, if I look at the market and I've had one trade, but I haven't hit my wage, I will allow myself to go back for a second trade. So I might trade the early morning London session, and then I'll trade after lunch again. You know, 2 trades. Once the second one's done, if that's over my daily wage, I'm done. That's me finished. But if I did the daily wage in the first trade, I'm still done. And that's kind of the way I do it. But while the trade is in process, I try not to look at the P&L. You do glance at it from time to time, but I try not to. But I'm a short-term trader. I'm a day trader. So I'm looking to be in and out of the market relatively quick, certainly within a couple of hours. That's a long trade. You know, if I can get in and out within an hour, fantastic. You know, and then I have passive income in the background, which is swing trades. And those I just look at the end of the day.
To me, it's a must. Not looking at the P&L on a daily basis, to me, is definitely something you need to do, because it's definitely tough to kind of keep track. If you see always your account balance going up and down and back and forth, it's very difficult to kind of keep going. But a lot of traders don't understand this too well. They want to keep looking at their balance. They want to know if they do well. They want to feel they want to feel the wins when they happen. They want to kind of see their account grow over time. That motivates them. But to me, that's definitely a wrong way to do it, in my opinion.
To me, if you're looking at the P&L all the time, the P&L swings, you're not really planning your trade out. That's almost like it's on a wing and a prayer. You know, I've got some money, grat. Whereas you should just like follow your trade through when it's complete. I'm a target trader, so I'll set a target, and I do split up the targets and various other things, because I'm a big advocate of not going 100% to market. I'll trade backwards. I know it sounds stupid, and a lot of newer traders don't get this, but a lot of older traders will. Dip your toe in the water and then build a position backwards, because the market always goes against you a little bit. So you just kind of get a better price. But I always have a fixed point of entry, a fixed point of stop, and I'll stage it within that. Because I was accused the other day of doing a martingale system. It's not even close to martingale. Martingale's doubling up your position every time it goes so far against you to eventually you explode. No, I have a fixed stop, I have a fixed entry, and I just stage into it, make the chart work for me. But I don't need to watch the P&L that much. But when the trade is complete, I fill my journal in, and then I'll take the P&L from that point. And I think that's another thing that a lot of newer traders, that they'll start a journal and they'll put the winners in, but then when they have a loser, they go, sick of it, I don't want to do this no more. I'm not filling this in, you know. I'll tell you what, I'll start a new week on Monday. Oh, I've got all green days, Gets to Thursday, you get clouded. I don't want to do this anymore. I'll start again on Monday. Whereas in really, it's those red days they should be concentrating on. You know, that's what should be in the journal the most. You know, what was my emotional state? Did I have my position too big? Did I get in too early? Did I pay any attention to my rules in the first place? All of this. And if you start seeing a pattern of your losers, you can start making rules to make it better. But they don't want to do that bit because, well, that's hard work, isn't it? And then it becomes a job. And you're told, we're not trading to have a job, we're trading to be free. Well, still got to do it. So it still has to be a job. It just so happens that your time is yours. You can do your job within a couple of hours, or you can do it over 12 hours. It's up to you. You can do what you want.
That's a good way of putting it, for sure. That definitely makes sense there. Going back to what you mentioned about scaling into your trades, how do you do that? I'm kind of curious to see how you would structure this. You have, how many positions do you allow yourself to stick within like one trade, and how quick do you re-enter the market?
I'll lay the trade up as if I'm going 100% to market. Okay. And what I mean by that is the first entry would be 100%. So I know what the target is, and I know what the maximum stop would be at that point. All right. And when I look at the chart, I'm looking for 2 structure points to hide a stop behind, because it will test the first one. And if it goes for the second one, I'm probably wrong. So at that point, common sense tells you to get up. So I know what the distances are. From that point, I'm terrible at getting in too early. And I know I am. And how do I know that? Because my journal tells me that. And this is something that's coming. Because just like everybody else, I'm only human. You know, you might think I'm not at times. My kids certainly don't think I'm human. But I am. So I know I get in too early. So what I do is, from the first entry to the stop, I'll break it up by 5. So I'll go 20% of the full position at entry 1. and these are spaced out equally. So what happens is the first 3 trades or the first 3 entries are probably the correct trade. So number 3 should be where I was in it the first time. Okay, so I'm scaling back to 3. Now, if I looked at sort of my risk reward, I'm not big on risk reward because I think you can force a trade with that, but they still need to have a place of, well, if this much is on the table as your investment, because I call it investment rather than risk, I want at least equal on the other side. Okay. Now, because you scale backwards and you're getting a better price, the more it goes against me, the more that RR increases. Okay. So I work back to 3. They will all go to full target. If it goes to stage 4, I'm looking to get out of the trade. And if it goes to stage 5, I am definitely looking to get out of the trade. But what I'm looking for at that point is when it does its quick retracement, and it might 4 and 5 will pay off 1 and 2, and they'll meet at 3, making it break even. Now, if it keeps on running and goes through break even, you might end up with, well, a small profit. You know, you might lose position 1, that could be red, but the others will pay off and give you a profit. And then if it finally hits the stop, well, it's still a hell of a lot cheaper than it was going 100% at position 1. So it's really just making the chart and the position size work for them. And it also gives you maneuverability as well, because you can see it run up and you might think this is out of steam on a 15-minute chart and it's going to pull back. Well, you can take your profits off, put your order back where it was before, let it come back and pick it up, and then you can carve while it's doing its consolidation before it runs off up into your full target. So again, you're using the chart to your advantage. Simple way of doing it. But if I go 100% to market, I've got nowhere to go. I can only add to that position. Well, that's stupid, you know.
Yeah, not a lot of traders do it that way, but it's a good principle to use. Definitely makes sense. If you have the chart in there, anyway, you might as well kind of benefit from these pullback in the markets. Not a bad thing to do for sure. Regarding stop losses, you said something interesting, which is you look for 2 points for your stop loss to confirm that your stop loss is at the right place in the market.
I do. I have what I call theoretical sort of stop, if you like. It's kind of just where I'm going to reassess the chart. Now, that's the first structure point. Now, that structure point can be anything. It could be a key level that I've wrote in that I don't want it to break. It can be the top of a swing that I don't want it to go past. Just something like that. And when it gets there, I'll be looking at the chart and thinking, am I right? Am I wrong? You know, but a lot of the time it will just go up to the level, test it, and then just come away. We see that all the time, just the oscillation of the market. But if it breaks through, I want to see where it's going. Now, that breakthrough might be a quick wick, and I don't want to be wicked out. So I look for the next structure point behind it. And at that point, I have a hard stop. And the hard stop is, if it hits it, the computer will make that decision for me. It'll just take me out the trade. That's it. Done. So I've got plenty of time to maneuver, because I am an advocate of a wider stop rather than a tight stop, because I personally think tight stops are death by 1,000 cuts, you know, and certainly for my style of trading, the way I am, I've just told you, I get in too early. I know I get in too early. So if I have a tight stop, I'm just going to get cut out all of the time. So I widen the stop out. It's still sort of, it's not ludicrously wide. It's like half an ATR or even a full ATR, depending on the market conditions. And I'll know what it is before the trade goes into place. I don't go, right, let's click and then drag a stop to where I think it might be. I've actually planned it all out before I press the button, because I use pending orders as well. I never just go click. So I've got time on my side. I can watch it.
Very interesting perspective there. So this is something I've not heard too much talk about. I'm sure people do it like without explaining it that way, but the way you explain it is very, very cool. So I might have to test it for myself too. It's a cool idea to check out for sure. Because like you said, sometimes you can play a stop loss and it could be a good stop loss, but the market will just go beyond a little bit, then you get stopped out for that. So would you prefer to kind of stay in the trade and have the trade work out later? Then yeah, it's possible. If you have a stop loss that's more in a second more logical place in the market. So it's a good point.
I think stops are probably, well, trading in general is an argumentative industry because everybody has an opinion on it, sort of thing. And if it's working for you, you're right. That's it. There's no argument in that. If it works for you, it can be the maddest system on the planet. But as long as you're consistent and you have more money at the end of the year than you did at the start of the year, you're right. Stops is exactly the same. If you're a nervous Nelly and you need a tight stop, that's fine, but you have to have the stability up here to know that your maybe is going to get clipped 6 times off the run. Now, the question is, can you press the button on the 7th time and at the same position size that you were going to take after you've just been hit 6 times? A lot of people can't, but then you've got the other side of the coin as well. What if your stop is way too big? Then it only takes one trade to knock you out of the equation. So you can, for me, I'm somewhere in the middle. I don't like a tight stop, but I don't want a haymaker that'll knock me out either. So I'm somewhere in the middle. And what I figured out over the years is, well, it often comes up to a level, and I trade the DAX a lot. The DAX is a vicious market, and it does wick quite a bit. I can see it wick 10 pips above a level on a regular basis, and then slam straight back down. So how do I combat that? Well, it's very simple. I mean, I use a system that I call GoldenEye, which breaks everything up into zones anyway. It'll come up to the zone. I'll have my stop in one that's the next zone up. But if it's going to spike into that one, I'm wrong. And I have to get out, because it's breaking through a major structure point that's key on the market. And I do stress key, because if I put a 5-minute level on, that means nothing. Absolutely jack all. But if I've got a daily on, and I've got a weekly and a monthly, and it smashes through that, there's a good reason why it smashed through it. And it's normally because there's a lot of money behind that move. And if there is, I probably haven't got enough money of my own to ride out what the big boys are doing. And that's my theory behind the two. I don't want them to take me out. I don't want to be manipulated out of the market, but I don't want to be cut to death either.
So your stop loss would be based on a bigger time frame than the time frame you use to place your trade, or would that be the same time frame?
I do multi-time frame. My chart layout is monthly, weekly, daily. So that's where I look at my chart layout. And I look for what I call a deep trend. Okay, so that's based on those 3 time frames. Now, I then look at what I call a mid trend or the day trend. And that'll be the day, 4 hour, and hourly. And if my day trend is aligning with the deep trend, I'll naturally have a bigger target because I'm going with the bigger money. Now, if I'm going against the deep trend or the deeper trend, I'll have a conservative target. And then from there, I break it down to the hourly chart is where I pay most of my attention. And I'll look at an hourly, a 15-minute, and a 5-minute, and I'll see what it's up to. Now, if that movement is in line with sort of the day 4 and the hour, right, we're on, okay? Target appropriately. Now it can be to the next structure point. If I'm going for a bigger target, I might be going to 2 structure points. And then from there, before I enter the trade, I do what's called +1, -1. So everything I do is on the hourly. All the ideas come from the hour because it's slow enough to show me what's going on. It's fast enough to trade. I'll go back up to the 4 hour to see if that's in alignment with the hour. And then I'll go down to the 15-minute to see if that's in alignment. And if them 3 are in alignment, we go time. So everything is multi-confirmation. So I'm trying to confirm what the big boys are doing, trying to confirm what's going on now, and then trying to confirm what's happening within the hour. And then I'll break it down into hour segments. I'll look at the chart at the top of each hour. If it's ready, we go. If it's not ready, well, then it's a case of let's have a cup of coffee, because we all know Scruffy likes the coffee, and I'll look at it in an hour's time. So again, it comes back to when you said, what do you focus on? It's routine. And it's just, that's my routine over and over. And I've already picked the market for the day, the workout strengths. I like to see which strongest and the weakest. Look at the 8 majors, and I predominantly only trade 4 markets. I'll trade anything, but my go-to are 4, which is cable, euro dollar, DAX, and the FTSE. And that's it. And I just constantly go through the same process every day. Apart from a Monday morning, Friday afternoon, because I don't like trade those times. I find them horrible times to trade. Certainly Friday afternoon. Friday afternoon is terrible.
Yeah, this is cool to hear you talk about this, because it's something that most traders don't think about, or I've never really heard people talk about this too much before. So, cool topic. Where can people connect with you or find out more about what you do after this podcast?
Oh, I'm very easy found. Just look for the Scruffy Trader on YouTube, or even just come along to my social medias. You'll find the Scruffy Traders everywhere. I answer everybody. So if you send me an email, drop a comment on any of the videos that I do, I personally answer every single one.
Yeah, the Scruffy Trader. I'll leave the link below the video for people to check it out and connect with you there. And you do some good work on YouTube and everywhere also around. So definitely good to have them follow you there for sure.
Oh, that's very kind to say.
Thank you, Gary. I appreciate your time here. I think it's been good to connect, good to see what you're doing these days, which is similar to last time, but different still in terms of the things we discussed here today. So looking forward to catch up with you again and see how you evolve in the future.
Always a pleasure. All the best to you.